Okay, let's start this. So, welcome everyone. Good morning or good afternoon to those in Europe. It's a great pleasure to have this first ChatTP session. That's a project conceived between HHP and Reise Fagundes to promote discussion on transfer pricing to create a learning environment, especially regarding the new TP law in Brazil, and allow us to get more experience and learning from cases already developed in other countries. So in that regard, it's a great pleasure, but mostly a privilege to have Professor Hans here, as well as Hilmar, Pilar Coutinho. Also, unfortunately, today she will not be joining us, but she's been very dedicated to this project as well. So yeah, so that's the intention. I think that we will also learn a lot through the sessions on how to best structure it, but we just wanted to get this going. The idea is to learn through discussion, through the presentation of cases that Professor Hans has prepared to us. And due to that, it's very important that everyone participates. So it's really a hands-on model. So the idea is not just for everyone to hear what Professor Hans has to tell us, but to contribute, to bring our experiences or questions, doubts, any sort of contribution will be welcomed. And that's it. So without anything else, let's get going. Start this.
Okay, you guys can start the presentation.
I'm gonna start. Yeah. Okay, just a second. Oh.
In the meanwhile, for everybody, indeed, raise your questions. Don't mind when I'm speaking, just raise your questions and it'll be fine.
Okay, I think it's on, right?
Well, let's go to the first slide then. Can I do that myself?
To
do that,
probably. But I can do it.
Do that, please. Do that, please.
Yeah.
So I just picked 4 situations where transfer pricing plays a role. 2 out of 4 are cases which we have worked on and we're already finished at the moment of writing. So and 2 of them are from the OST Model Text Convention. However, the 3rd case, which is from the OST Model Text Convention, is since yesterday also a practical case was in the Netherlands. So I can share a lot of the experiences with the tax administrations and how these things have been are being developed. But I assume we could go to a basic case, which is the first one, the old-fashioned conversion of a fully fledged enterprise to commissioned agent. Perhaps you can go to the next slide. This is just one of these main issues which you find back already in the OST BEPS plans from 2015. This is one of the situations which is happening a lot, namely where a fully fledged enterprise, so an enterprise, let us just say, with all the functions, assets and risks, and you convert it in a limited risk kind of a situation. That can be a toller manufacturer, it can be a commission agent structure, but in any situation, a conversion from a fully fledged to a limited enterprise. And the consequence of it is, of course, quite clear. Where in the past, in this specific situation in Spain, everybody works from Spain, so the whole profit is taxable in Spain. after the conversion, with a strict tax planning, even after the MLI, after the conversion, only a limited profit is taxable in Spain. And there are here a few issues. First of all, we can all see, I assume, that a real part of the possibilities to create profit has been actually brought into another country. So the exit taxes is here the main issue. But what we see in practice in Europe nowadays, and that's a new development, is that a lot of countries take the position that if after a conversion to a more limited profitable entity, they will look at the increase of the profitability in the other country. Germany does it, for example, that way, and will remain taxing under domestic anti-abuse legislation the profit in a country like Spain. So if you want to convert a fully fledged enterprise either in Brazil or in other country in order to optimize your taxes or to optimize the structure from a risk perspective, because you create one holding where all the risks are actually being performed, keep in mind that it's part of transfer pricing, but it's actually that you have to levy an exit tax on the present value of the future income. So
So the feed from Professor froze to me. Is everyone being able to hear?
Yeah, I hear you.
Okay. What about Professor Hans?
Hans is frozen.
Okay.
Hans?
I wanted to know if that was me or...
No, it is just him, I believe. I will try to call him. Maybe mobile. So if you wait.
Yeah, sure.
Hans. I don't know if he picks up because he's in. Hoi, Hans. Ja, je beeld is bevroren. Dus we zien je wel, maar we horen niks meer. Dus misschien kan je iets doen, een slimme truc. Ik weet ook niet. Refreshen. Hoor je nu bijna? Ja, daar ben je weer. Oké, bedankt. Hoi. Hoi.
Ja, hoi.
Okay.
I hope this works now. And my apologies. Apparently, I was away and I was speaking a lot. Let's just go back to the beginning. So we have a fully fledged profitable enterprise in Spain. And Spain has a much higher tax rate than Switzerland. And therefore, from a tax optimization perspective, it's getting interesting to actually put more risks and so on in Switzerland, and by doing so, limiting the tax base in Spain. Happens a lot. This is one of the main issues in transfer pricing. This is also one of the main focuses if you would read the OECD BEPS action plans from 2015. Actions 8 to 10 deal with transfer pricing. And the first one is this example. the example of converting a fully fledged enterprise into a commission agent. By the way, do you guys still hear me? Okay. Just for certainty reasons. If this happens, the OECD transfer pricing guidelines actually say that the conversion from a fully fledged enterprise into for example, a commission agent or a toller manufacturer leads to an exit tax in the country where the functions or the risks are being excluded. And that means that you have to look in the present value of the future revenues as a basis for a goodwill exit taxation. In one of the cases we are going to have, because this is a discussion with the Dutch tax administration, we had a situation where actually also the activities, the functions were they were in the Netherlands, and the company carried them over to Poland. Why to Poland? Because the wages are a lot lower than in the Netherlands. And here also the tax administration wanted to levy based on the guidelines an exit tax from the company. The point, however, here is that the reallocation of functions to Poland was necessary from a business perspective, because due to the high wages in the Netherlands, the product couldn't be made anymore in the Netherlands. It was a lot of labor involved, very technical labor involved. And with the Dutch wages, it was always a negative result. So as a consequence, we had a discussion with the tax administration that if you look at the present value of future revenues from this activity, that would be negative instead of a positive amount, because wages are so high that producing in the Netherlands would in the end mean that they would be loss-making forever. So how can you then levy a goodwill in this specific situation? Well, we solved that issue, but in a recent discussion, actually a discussion yesterday with the tax administration, the Dutch tax inspector now takes the position that by bringing the business from the Netherlands to Poland, in the real life example, that he believes that there should be a profit split in place. You might have seen that OECD has 5 methods. There is also 6, which is popular in Latin America, but regularly 5 methods, and the profit split method is the 5th method, and can, according to OECD, only be applied if both parties play an essential role in a business. And in my current situation, that's not the case. So this is again a situation which is going to go to the court soon. But the most important takeaway is that in principle, the exit state is allowed to levy an exit tax, and that can be calculated based on the present value of the future revenues. But if you do the reorganization due to the fact, like in my situation, that the wages in a certain state are much more high than in another state, then in that situation, it could be different. Any questions from your side? Or any questions dealing with this indirectly, or any other things you want to ask? Very open to answer all your questions.
No, I think it is clear.
It's clear. It's an interesting case, because I think it relates a lot to most business in Brazil, where we're structured either as a distributor or an agent, either a full-fledged company. But in many cases, we have a development of the activities throughout the year. So maybe a foreign group will start getting agents here in Brazil, and then this business will develop into more of a distribution and then a full-fledged enterprise. So it's it's important to see these concepts, how TP guidelines and TP cases use this business model also to search for comparables. And I brought here some articles of the new law in Brazil that have connection in some aspects to the case. So I think we have the, well, it is translated into English, but basically the one that defines how the functions, the assets, and the risks have to be analyzed in each case to determine the base transaction and then search for the comparables. And I think this is pretty much the issue here, right? Understanding in this different business model that groups can have, how these aspects are related. So what actual functions, assets, and risks are taken by the entities. And in these item 1 here, I think this is a very interesting as well, because you should look at the effective conduct. So not only what is written in paper, if you have an agreement or whatever you have that tells a story, but you have to see effectively how the business is conducted, what happens in reality, and combine these analyses for your TP study. So I think this is maybe an important aspect to take from these case.
Yeah.
Can I add one thing? Yeah, this is your law, and this is indeed based on the guidelines. The consequence which I described about the meeting I had actually yesterday with the client of the tax administration is that the profit split situation isn't based actually on the transfer pricing guidelines as such. It is actually the consequence of the attitude of a lot of tax administrations, where they say that the reorganization is based, amongst others, on taxation reasons. And for this, they will apply, under the tax treaty, an avoidance perspective. Avoidance isn't defined in the tax treaty. So transfer pricing is linked with the tax treaty via Article 9. And therefore, they go via Article 3, paragraph 2, for the definition to domestic law. And then they say, based on our domestic law, this is avoidance, and therefore we have the right to apply any system we want, including this profit split method. So this is, in the basis of the case, is a clear one. But the consequence where states take deviating positions make it quite complex, unfortunately.
Okay.
Yeah, I see, and I already anticipate that we will have these sort of issues, thinking that typically our tax administration tends to have some strong positions that are not necessarily in line with practice in other countries, including with treaty issues. So, for instance, we had these long discussion regarding payment of technical services abroad, which Brazilian companies do a lot. And most Brazilian treaties have a protocol that makes applicable a royalty article instead of business profit article. So it's always an issue to how to avoid taxation in Brazil, not to have a withholding tax. And especially because then the domestic law has a very broad concept of what technical services would be. So basically, every service that is actually imported by Brazilian entities falls within the scope of the domestic law. So now that we are changing our TP law, I already think that we're going to have a lot of these issues. So based on the interpretations by our tax authorities and domestic law, that should most likely create a lot of litigation and other discussions.
I can tell you that in 2018, in Geneva, Switzerland, the United Nations discussed technical services under Article 12A of the UN Model Tax Convention. I was there on their invitation. And what I recall quite well is that technical services was something which the UN states wanted to have in the tax treaties. Some said we like Article 12A. Some said we can do it at 5.3b of the Model Tax Convention. And also a major group of countries just said we just use the royalty article because under the UN Tax Convention, everything is in the scope of the royalty article. So we can always tax everything we want to tax. So I think that might indeed be an issue in Brazil, although the OECD perspective is that technical services shouldn't be taxed, but with an exception under certain circumstances. But I'm not fully sure whether in 2014, you're now an OECD member, the tax policy also changed in Brazil. Any ideas?
Yeah.
Flavio, any ideas about it?
No, I'm not sure.
I think that they will just bridge both and just say we're now an OECD member, so we tax everything under the transfer pricing rules and the abuse provisions, but also keep alive the 12B kind of technical service because it just creates income.
That could be maybe an interesting addition to the slides, because the first slide from Hans on the structured, like a structured chart, I thought, oh, that could be somewhat more dynamic, like calls to action from the participants of the presentation. And now we have this nice add-on suggestion that you made, Hans. And that is also something that makes the presentation more lively, how do you say that? Very good suggestion. Your question is very interesting. It helps the participants to actively participate, because it's an interesting question, and how to solve the question with what kind of answer, that could be also part of a slide.
12B, you mean?
Yeah.
We cannot change it now, but it's the good thing is of these kind of discussions.
Yeah.
That you start with transfer pricing and you see how the interaction works.
Yeah.
The transfer pricing, international tax, and for Flavio, we discussed it already a few times.
Yeah.
What we see in the West, in the OECD world, is that in the past, transfer pricing was done by transfer pricing specialists. International tax was done by international tax specialists.
But
with the behavior of more and more states, you see these things being interacted. So if you deal with transfer pricing, you have to deal with international tax and vice versa. Yeah, that's true.
Yeah, that's true. That is, and that is indeed also a big opportunity to sell the service. If you can make the interaction between both segments very clear.
Yeah,
because it's still the old-fashioned way. International tax specialists versus the TP specialists.
Yeah, but that's the old-fashioned way indeed. Yeah. Perhaps the next slide.
Yes.
Yeah, this is a court case, a real one, which actually didn't reach the court because we could conclude a very good compromise. It's a Big Four case, so we did the tax audit for them. and it's the first EU multilateral transfer pricing audit. So what does it mean? We had to deal with a Belgian multinational, had subsidiaries in, now it's more than just these 4 countries, but in several countries. And the Dutch tax inspector noticed that procurement was being transferred to Switzerland for good reasons, because the company was expanding. They were creating new entities all around the globe, in Latin America, in America, North America, UK. So it was becoming a multinational player. And in order to make the whole structure more effective, they centralized procurement in Switzerland. And how does it work? A multilateral audit, as we do it in the European Union, the Dutch tax administration reaches out to the other tax administrations and asks them to join them in a transfer pricing audit. And these 4 countries, Spain, France, Netherlands, and Belgium, they agreed that they would go in this multilateral transfer pricing audit. I said the first in Europe. And how does it then work? After they created their strategy, they invited the CEO and the CFO to the Ministry of Finance of the country where the headquarters is located, which is Belgium. And then they discuss with CEO and CFO what they're going to do. Important are 2 things. First of all, in the past, international tax companies, the Big Four, for example, they are everywhere in the world. So whenever they wanted to do a tax planning, they created a strategy with all the countries and rolled it out. And the tax administration said, just to look what's happening here. We don't understand this, and they are actually, in a disadvantageous situation. The countries now reverse that by doing exactly the same. So they created their strategy. They invited the CEO and the CFO to the Ministry of Finance in Belgium, and they told the CEO and CFO, listen, we see something happening in your company. We don't like that. The outsourcing of procurement to Switzerland, we don't like that. And we are going to perform a tax audit. Are you going to cooperate with this tax audit? Was the question. What do you do whenever you're a CEO and CFO? You say, yes, we will support you fully. We have nothing to hide, etc., 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 etc. So this happened, and then you have technical discussions, but also practical discussions. One of the consequences from agreeing as CEO and CFO to fully support the tax audit is, for example, that in the Netherlands, tax inspectors went to the Dutch factory and asked the director of the Dutch factory, can you explain to us what happened? Because we noticed that the procurement was outsourced to Switzerland, so you have possibly now less things to do in your business. And if you ask a director something about what he's doing and then suggest that he has less things to do, he's going to say, no, that much happened. I'm still very busy with everything and so on. So this was the first plus for the tax administration. So they said in our first meeting, listen, guys, this is nonsense. There is nothing really being outsourced, because we spoke to these people, the director, no, he just said he's still doing the same thing. So one thing, if you ever have a tax audit, a transfer pricing audit, or not let a transfer pricing audit, make sure that you train your client, that you train your colleagues, if you're an in-house tax advisor, that if a tax inspector is going to visit, that you will always be there. Yeah. And don't feel confident that these tax inspectors are very nice people. They are very nice people, but in the meanwhile, they will note everything they can use and they're going to use it against you. So that was one issue which played a role here. The second issue was here that the activity in Switzerland was a real activity, was a growing activity. And in our first ever webinar with Flavio, I discussed a little bit about benchmarking. And benchmarking played a role here. So what happened, the Big Four, which had done the transfer pricing structure and is doing all the tax returns and so on, they created benchmark. So what they do, they are selecting comparable companies in a range, limiting the range more and more and more, and in the end came out with a range of 35 companies, which were a little bit comparable to their perspective, and came to a benchmark, came to a allocation of profit based on a benchmark for Switzerland. And in the first meeting we had, after the discussion about these facts I just mentioned, the tax inspector said to me, literally, listen, Hans, this is all very interesting, but everything is being benchmarked by this Big Four, but we are going to reject the benchmark because the benchmark is just not correct. Okay, and why do you think the benchmark is not correct? Well, he said the benchmark is not correct because if I look to these comparable companies, this was a producer in the food industry, and the comparable companies are like reading glasses, glasses, tables, etc., and not just food kind of things. And I thought, okay, this is quite an issue because you can imagine that comparability plays a role. But if some of you were also online when we did the first webinar, I asked the participants the question, what is the most comparable company to that US company making these big machines, Caterpillar? And you all came up with John Deere, etc., etc., etc. And I said actually Nespresso, because you have to look to a business not just based on what they do, but on the business model and how they create profit. So I asked the tax inspector what his alternative would be. And he said, what we are going to do is we are going to use the so-called JITSIC procurement benchmark. And JITSIC is an organization of Western countries, not just EU countries, but also non-EU countries, which develop with all these countries for specific transaction, specific benchmarks. So they just said, we're going to use the JITSIC benchmark, and as a consequence, more is taxable in Netherlands. So what do you do in your role? You ask more information about the JITSIC benchmark. So they sent me the JITSIC benchmark. And as I tell you that this is a benchmark which is going to be used in all procurement situations, there were ladies' dresses in the benchmark, there were trees in the benchmark, there were coffee cups in the benchmark, there were books in the benchmark. So I said to my colleague Frank, this is quite strange. They reject the Big Four benchmark, and they come now up with a benchmark which has actually the same flaws, which is actually the same sort of companies in it, which are from their activity non-comparable. So in the second meeting we had, the question was raised by me. I just want to say something about the benchmark of the Big Four and the benchmark the tax administrators are going to have chosen. And he said, there are always a couple of people from the tax departments, from many countries, from the 4 countries, and the head was a Dutch tax inspector. And then the head of the tax administration said, Hans, we understand what you're saying, we accept the benchmark from PwC. So it was okay now, but it shows you how these tax administrations try to push you in a certain direction in order to win the situation. But we weren't done yet, because the next question was actually, if you look at procurement activities, the question is always, what do you allocate to procurement activities? Is the benefit from procurement activity, is that just taxable in Switzerland or elsewhere? So from the transfer pricing guidelines, you can read that procurement activities are taxed in the country where the procurement hub is located based on a service fee. And the residual, so the difference, if all the countries would do this, their own procurement versus the benefit if you procure centrally, that residual is allocated over all the parties using the products. Let me just call it that way. And then the height of what's allocable to Switzerland depends mainly on the risk profile. And I remember that the tax inspector said, yeah, but there's no risk in Switzerland. So why would we accept a service fee? And what the Big Four, and in the meanwhile, know which Big Four, done brilliantly, was in their structure, they, in the transfer pricing documentation, they actually had a reward model which depends on pluses and minuses. So if they would be able to do the procurement for food ingredients below the market average, then they would get a reward. And the more below the average, they would get a higher reward. But if, due to circumstances, their procurement would lead to a situation where the market does better than they do, they have to pay. And what had happened in those years, there was the fipronil egg crisis, that the poisoning of the eggs, and in the food industry, a lot of eggs are being used. And therefore, this procurement company actually had to pay in a certain year. And that proved that that entity was also risk-making. Well, what was the agreement we concluded? So we could prove there was risk. With the company, we actually discussed what they would feel an acceptable transaction. So what do we find is the additional taxation in the Netherlands in a percentage? And we said, if we can get a plus in the Netherlands and all the other countries from, let us say, 3% based on the tax returns, the CEO and the CFO said that would be fine for us. If not, we're going to go to the court. What happened? We had a discussion, and we said to the tax administration, let us go a little bit, let us break up now. So we went with the team of the company to another room and discussed that we would like 3%. Came back, the tax administration did the same thing, so the tax inspectors, and we asked them what they felt was reasonable. And they came up with 3%, what we liked. So what do? Then you reject that. Because if they already are on 3%, then you want more. Because it's always a negotiation. So we asked them to break up a little, to consider their proposal. And we said, okay, let's not accept this, and let's try to go to 2% or something like that. So in the end, we came in the middle, 2.5%. So we were lower, less additional taxation than actually we hoped we had to pay in this specific case. So this is transfer pricing from a very technical point of view, procurement activities, chapter 1, but also the benchmarking, how do you make your comparables, and what do you do with the actual functions, assets, and risks. And here you also see how it works in practice if you have to do it in the Netherlands. And I know that the Brazilian tax administration cooperates a lot with the EU tax administrations in order to get up to speed. So I assume you will get the same discussions, possibly in your country. Flavio.
Very, very interesting. A lot of different angles to this case. But regarding this last one, I actually have a question. This model of having a higher or a lower commission, or even having to pay, was that already in place, or was it part of a planning before setting up the procurement structure? Already, was that already anticipated as a TP measure to mitigate any risks, or no? Was that really part of the model, and it was also used to support TP, the TP study? That's I think that's the question I wanted to know. Do you happen to know how was these structure with this company?
Yeah, well, when the company, which is growing rapidly, came to the conclusion that they should outsource the procurement to a dependent company in Switzerland, the Big Four did it quite seriously. So they said, okay, there have to be a real office there. There have to be real people working there. So a Belgian guy and I believe a Spanish guy, they relocated to Switzerland. They hired staff over there. So they had a real group of people working there. And the Big Four said, well, then let's make sure in the transfer pricing documentation and in the agreements, the intra-group agreements, that this company is a company which is really incurring risk, because that's going to be an issue. And that vision of the Big Four was quite good. That vision was good. And therefore we were able, and they included therefore in the agreement, this negative positive kind of agreement. So if you guys do less than the market does, you have to pay. And it really happened that way. And and that helped in the discussion a lot, because by this we could prove that based on the agreements and also in practice, we could demonstrate that the company in Switzerland paid money because they didn't do a good business during this crisis. So it helped a lot. But it was created from scratch.
You see. Yeah, that's really interesting. So would anyone else like to contribute, make any remarks, questions?
Maybe technical, maybe also be practical.
Yeah.
Any participant, any question or any situation which you want to share and want our comments on, please be free.
Yeah. Not necessarily regarding this case, but maybe you have
any case.
Your own. Yeah. And also feel free to use the chat box if you prefer to write instead of opening the mic. That's okay too. So as you prefer. In the meanwhile, I just brought for this some paragraphs that brings more about the risks. So just to, so that we can relate topics being discussed with the case, with our legislation. So pretty much these paragraphs are part of the article that I already mentioned in the other slide. So how the risks should be taken into consideration. And it's, well, the first one, I think it's kind of a loop. It says that, I don't know, I find it kind of funny. It says, it tries to define what an economically significant risk is. And that is that significantly influence the economic results. So it's Like the answer and the question is the same. It's right. But then it says that shall be considered assumed, but that the party of the control transaction that exercise the functions related to their control and possesses the financial capacity to assume them. So this, I think, also relates to the other comment that you have to actually have the means to assume these risks. Cannot be just on the agreement says that you will take these risks, but if anything happens, you don't have the means to assume it, or you're not really in control of these risks, the managing of these risks, then that should be probably disregarded in an inspection. Right?
I can actually give you an example also from our practice, which I didn't put on the slide, but it's interesting because it deals with risk. This is a company which makes tires for industrial things. So, but also for these main machines which go into a mine. If you ever been in a mine, then you know that these machines are huge, and these wheels are sometimes 4 or 5 meters high because it's really a typical thing. And they made these specific big wheels in China. They bought a factory there, and the board existed from people from Australia, the Netherlands, it's a Dutch firm, the Netherlands, Canada, US, and another country, China, of course. And the question, and from Hong Kong, these tires are being procured in China with their factory and being sold to countries where they have mines and these machines. And of course, the Dutch tax administration said that everything happened from the Netherlands because it was owned by a Netherlands firm, and they wanted to tax this. And then there were two main issues here: functions and risks. Function is what's really happening in Hong Kong. The risks is helemaal Piet going off. The risk is the question whether any risk could be incurred by this Hong Kong company. And what happens if in a mine, such a huge machine in a diamond mine or a coal, I don't know what kind of mine nowadays, but if such a tire goes flat due to a fault in the tire, a fabrication fault, there is a liability. Because then the company has to pay damages to the mining company. And that actually happened. So that machine was due to a broken tire, was 2 or 3 weeks just not operating. And then it goes already in hundreds of thousands of US dollars, the damage. And they had such a case and they had to pay it. So based on that payment, and they paid it themselves because they had money there in Hong Kong, they had the management was there, and they were able to carry the risk and to actually pay if a risk was effectuated. So it's very important that if you say in your transfer pricing documentation with your company or your client that, we assume the risks, that's fine. Then functionally assume the risk. So what do the people do there if risk happens? So in my case, the management team there actually dived into the problem. What has happened? They sent sometimes somebody to the mine or just ask photographs, and they judge what has happened. And then they say, so functionality perspective of risk. And then they say, okay, fine. Yeah, this is a broken tire due to our fault. We are liable. We are going to pay it. Discuss from Hong Kong with the company what the damages are, and then they pay from their own money, which is in that company. And then you have the risk perspective covered from functionality perspective and a financial perspective. And that's essential. So for practice, 2 things. If you say you have a risk, then that's sure that you have the people to manage that risk, and you have the money to pay a liability if necessary.
Yeah. All right. should we move to the next case?
Fine. Yeah, this is this one. This is actually the situation, which is also from the transfer pricing guidelines. But as I mentioned, since yesterday, this is also a court case, going to be a court case for us. What do you do if you have already touched it a little bit in the first case, but this is more specifically about the profit allocation and not more specifically about the procurement function. And this element, this example here deals with procurement, but it has the same role if it's about cash pools or treasury functions or whatever more. And what does it say? It's actually the following. If you centralize functions, then you have many reasons for it. One of the reasons is to create bigger advantages, benefits, like a lower procurement price or like a more optimal interest rate if you are dealing with a cash pool and benefits in that cash pool if it's a non-notional one, or even in a notional cash pool that you can optimize the situations with the banks and the company, etc., etc., etc. So you do that to create business advantages. But these business advantages lead to a higher profit. Always, the more I optimize my procurement, the higher my profit, and therefore leads to higher taxation. And the question is, because it's all about multinational, which from these companies is going to benefit from it? If the cash pool would be in the Netherlands, and due to an effective cash pool, a multinational saves 10 million on all the loan structures worldwide and all the interest being paid, then the question arises, is that 10 million taxable in the Netherlands? And OECD has, in the transfer pricing guidelines, explained how it works. And the more simple way to understand it is the widget example. And it actually says something like, I put some figures here on the slide. If each company would procure their own widgets, they would cost $140. And they sell in 120 hubs, 1,000 widgets a day, so 120,000 widgets. Well, the figures and so on, just an example. If procurement is centralized, the company can buy these widgets at $50. So therefore, the benefit is 120,000 multiplied with 90 is $10 million per annum. In the second bullet point, by the way, is 1,000 widgets per day. That must be per annum, of course. So the net benefit is more than 10 million. The interest rate in the procurement company is 10%, while the other companies have 25%. So it's a net benefit for the company of 1.6 million per annum. And the question then is, what do you do tax-wise? The last bullet point, the tax benefit is more than 10 million, is just to give you an illustration of what it means. But the discussion is higher in the bullet points. And the discussion is actually like, okay, so 10 million euros per year is the benefit by an optimized procurement or a cash pool or whatever more. But is it really, in procurement terms, is it really the procurement company which create that benefit? Or is it the consequence of having 120 countries buying these widgets? And whenever they procure individually, it's logical that they get a less beneficial price. And therefore, OECD says that if a company is doing has outsourced all the procurement, the business to one entity, that entity is allowed to receive a service fee. And the service fee is normally based on a cost plus kind of a system. So 5, 6 in the examples of OECD, depending on the risk they incur. And the residual is taxable in only one, not only one country, in all countries, but the procurement company country, because 120 entities, 120 countries procure these widgets, and therefore their total activity creates the benefit, and therefore the benefit should be shared over all these companies. So this means in this example that we have 10 million, almost 11 million US dollars to share. In practice, it means that you get a service fee for the procurement company. Let us say that the procurement company costs 1 million a year. All the people working there, let us say they incur the risk, so 6%. So with 1 million, it means that 60,000 euros is the service fee on the cost plus the service fee the procurement company deserves, but the residual is allocated all over the country hubs, which also buy and sell. With procurement, it's quite simple. With cash pools and treasury functions, it's much more complex because in a cash pool you have pluses and minuses. So what do? So if you have two countries only, and the third where the cash pool is, and one country loans 100 million, and the other country they provide 50 million. So net need for finance is 50 million. And by doing it centrally in a cash pool, there's a benefit, let us say, of 5 million. Let us say, just say 10%. How are you going to allocate that over both parties? The country which provides the means to the other country, whereby the other country doesn't need to have a loan of 100, but just on 50 million, probably gets part of the benefit. And the cash pool itself gets a little bit of the benefit, the service fee. And that's a little bit how it goes. But it's getting complex in cash pools because you have minuses and pluses, and they vary during the year and so on and so on. But it's the basic perspective for OST to deal with it this way. Simple with procurement, complex with financial transactions. Let me just conclude with that. And normally, try, it's a practical perspective, in a cash pool situation, try to find a solution with relevant countries. What I saw until 2-3 years ago is that even the Western countries, they looked at this, raised some questions, and more or less accepted this. There are a few court cases if I recall well, in Denmark and in Australia, where cash pool played a role, transfer pricing perspective, but not too many cases. But the last 2-3 years, we see a huge increase in transfer pricing disputes in Europe, in the Western, in the European Union, and these discussions are going to come up, I think, quite soon. So whenever you have to deal with financial transactions, you have to really think about creating a system where you can monitor all the cash in and cash out, and possibly actually normally you would expect on a daily basis, but that's just too complex. It's quite a model you have to build if you really want to allocate the pluses and the minuses over all the participating countries. But there will be countries soon, I expect, because I see it happening in the European Union, which are going to say we want part of that benefit because the company in this country provided the money, and therefore we want a plus. We want main part of the residual, not just a service fee, because we don't service. We want a real plus on the interest we the loan we provided to the minus companies in the group.
Yes. Again, very different angles. It's quite interesting. I have selected here an article of the Brazilian law, which refers to synergy effects. I think it relates to this procurement case. So basically, whenever you have a structure that it is intended to create a benefit, or maybe it will lead to a loss, then you have tried to allocate how each party contribute to this effect. And that's, I think, exactly the point you're making. So in the procurement case, what is effectively the value created by the procurement company, and what is due to the aggregation of all these 120 entities spread worldwide that are concentrating their procurement. Same with the cash pool model, which is much more complex. And in every case, you have to have these economic analysis, right? Try to get to the bottom of the business intent, and thinking about the arm's length principle in its roots, like how would independent parties act in a similar situation. So that's maybe the North Star here that we should seek, but in practice, it's always very complex and not that evident, right?
How is it in Brazil, Flavio? Are there already cash pool systems in place? How does the tax administration look at it? A treasury function?
Well, we have, and tax administrations tend to see it as some sort of different loan agreements. Try to see the position of the creditors and debtors, and depending on the situation, these have different impacts. But it's not, we don't have a specific regulation for cash pool agreements. It's not
And if suppose let us say just an American multinational with a Brazilian subsidiary, and there's a treasury function or a cash pool in place, then the tax administration doesn't yet raise questions about how it works and whether the benefit is sufficiently taxed. Perhaps any of the other participants have experience with it. I'm just very curious to know how it goes currently in Brazil. I would love to hear your opinions also. Any one of the participants wanting to bring some experience to the table on cash pools, treasury functions?
okay. All right. So
Yeah.
get back to our last case of the day.
This last case, ladies and gentlemen, is a case, an existing case we were currently working on. We were involved only less than a year ago in this specific court case, and here you see the interaction between transfer pricing and international tax, and here you see that the previous advisors made a very TP-related practical mistake. What is going on? In principle, it's quite simple. It's a Dutch company in the food industry, a different one than the other, which is building in Germany a new factory. Well, the factory costs a lot of money. So a request for funding went from Germany, they already had a company there, to the Netherlands. And how it goes, and I'm telling you this because it's important, how it goes, then there is this finance department, which makes an analysis with the strategy department on whether it's feasible to have a factory there and what the future of the product is, etc., etc., etc. If there's a positive advice, it goes to the board in the Netherlands, and the board decides on whether they get the funding, yes or no, and then they get the money and build the factory. The German tax inspectors, and Germany is the, let me just say, the pain in the, and then the last word I will leave out, in Europe, because they challenge any transfer pricing situation anyhow. So they here said that the interest rate on the loan from Germany to the Netherlands was too low. And then you say, oh, too low, that means that it should be higher. That means that there's a higher deduction in Germany. Correct. But they say that the loan is eligible to a fictitious permanent establishment in Germany, and therefore it's higher deductible at the factory, but it's also taxable at the same rate in a permanent establishment, which for Germany means that there is no deduction at all, because the plus and the minus, they are being compensated due to the permanent establishment. Otherwise, they would have just a negative situation. So, and the reason why they do this, because they say, and don't ask me why, it's the German Außensteuer says, they say it's an abusive situation. Well, what can be abusive? Providing money to a subsidiary to build a new factory. My country would be very happy to welcome a new factory, but the Germans see it in a way like differently. So, and the mistake which has been made is because the tax inspector said the interest rate is too low, that the company with the tax advisors, in first instance, went for a mutual agreement procedure. So what did they say? They say, we want an agreement on the interest rate. But that's not really the issue. And now it comes, the Germans say, this is the MAP procedure. We have had meetings with our tax administration, Minister of Finance, and so we know how the discussions go, and they actually don't go, because the German tax administration says, yeah, but it's abuse. And based on the mutual agreement procedure rules, if it's abuse of law, there is no need to find a solution. Now, it is a death solution, because it just doesn't work. So what they should have done is to go via a case against tax assessment under the tax treaty, because it's here just a matter of qualification. It's not about transfer price, it's about qualification. Can a loan provided to a foreign subsidiary create a permanent establishment in the country where the subsidiary is actually located? And of course, it can't be done. But, and then you go to the situation where you can bring to the German court after the assessment. You say that the German execution of the law infringes the tax treaty, and in our special case also European Union law, freedom of establishment. But they went for the mutual agreement procedure, and I said it's about the interest rate, and the Germans say it's abuse, and then it's just not possible anymore. If one of the two states say it's abuse, then OECD says, well, try to find a solution. But states are allowed to say, in a situation of abuse, we don't accept the map. And since abuse has not been defined in the treaty, via 3, paragraph 2, you go back to domestic law, and via that situation, you just exclude the map. So the states are still discussing it for years, but it's not going to bring any solution. So what we're now trying to do is to put pressure on the tax administration in Germany and ask them to come up with a tax assessment. Then we have access to the tax court in Germany, and they bring to the table first the infringement of the tax treaty, because everybody sees that this is not the situation, but it's a real life situation now. And secondly, we can apply freedom of establishment under EU law, and bringing that this infringes the rights of the Dutch company to actually enter the German market. It's an atypical case, but it illustrates a lot how even, OECD is for the major part EU member states. And so I dare to say that Germany and France are the main, together with the US, the main funders of the OECD and the biggest influence on OECD. And then if you look at this case, you think, how can this happen with a country which is one of the main supporters of the OECD transfer pricing guidelines? After the US, Germany is number 2. And the Pillar 2, global minimum tax rules, Germany was actually number 1 in promoting. So they are fully supporting OECD rules, or actually inventing them, like Pillar 2, and for the major part also Pillar 1. And here you see, because it's a financial interest for them, and not that high, because it's about millions a year in tax deduction, but it's still relatively small amount of money compared to the bigger companies over there. And here you see that they then just go in this way, like, we want everything. And it's quite surprising that in the EU, the inventors of OECD more or less come up with these very stupid situations. So, and this is not the only one, this is not the first one. We see this happen a lot. This is just one of the currently pending ones. So I assume that in Brazil, the tax administration possibly is going to use the same creativity and flexibility, and that also there are some difficult court cases are going to follow. Questions?
Yes. Marta, please feel free.
Yes. Hi, Mr. Hans. Hi, Flavio. I'm Marta from Hurk, and I'm not going to make any comments related to the case, but I have a question here. Since I noticed, Mr. Hans, when you mentioned how the tax authorities work in most of the cases, I'm curious, since my headquarters in Germany, and you mentioned that Germany is one of the main countries that work with US in the OECD rules. Do you think this could be helpful for me in Brazil when I talk to the tax authorities in Brazil? Because I'm starting to be very afraid related to the TP cases, because I didn't know that there are so many issues. And we are already expecting a lot of issues since the rules are changing now for us. So if you can make any comments, I really appreciate. Thank you.
I'm going to give it a try. I think if your company is Germany based, then you have less problems. Because what I see is that any company which is non-German based and having activities in Germany, they all have to deal with transfer pricing. They all have to deal with abusive fraud. They all have to deal with the withholding taxes on interest and dividend and royalties, etc., etc. They all have issues. But the influence of Germany in OECD is that they play a leading role in the development of approaches. But I don't think that any Brazilian tax inspector will see that as an influence, because if it is already a discussions going on between Germany and Brazil, it is going to be on the Ministry of Finance level, because your Ministry of Finance discusses within OECD any new development, because you're now a member. So I don't think that's going to help you.
Okay.
And there's this other thing, that's under international rules, you only have to deal with the map. Within the European Union, we have an arbitration directive, so we have additional means to challenge it. If any issue arises between Germany and Brazil, you can apply the map. And if the Brazilian tax authorities are really going to make a mess, then it depends on whether possibly Germany and Brazil, I don't think so, might have a bilateral investment treaty. And then you could possibly invoke a case before arbitration panel on the fair and equitable treatment provision of a bilateral investment treaty. I don't think Germany has a lot. And since Germany only recently has a tax treaty with Brazil, I believe, I don't think they will have a investment treaty with Brazil. But normally, for example, in relation to Peru and Chile, specifically Peru has an investment treaty with the Netherlands. So in any situation where the Peruvian tax administration really makes a lot of difficulties, we know that going to the Peruvian courts doesn't really help. Smaller country, less developed court system, etc., etc., etc. And then normally, if the tax administration does strange things, we try to invoke under the bilateral investment treaty the fair and equitable treatment provision. But I don't think, very specific to your question, I don't think it's going to help you that your headquarters is in Germany.
Okay. I just want to know if the fact that Germany was like so had so much of experience on this topic, if it would help in Brazil for the tax authorities, but I don't think they would consider that at all. Okay,
and
thank you.
Article 3, paragraph 2 from any treaty gives any state the possibility to just say it's abuse because it's not being defined in the treaty, and then just go to the domestic anti-abuse rules. And this is the main issue about these all new developments the last 10 years, all these new rules, etc., etc., etc. Taxpayer protection, taxpayer rights is just not taken care of. That would be in Action 14, BEPS Action 14, and it's actually a failure. Sometimes, and possibly if Brazil, and that could be a solution if it happens, but if Brazil and Germany have see each other as a contracting state under the MLI, and indeed if they also have, besides the minimum position, also agreed on arbitration, then you could possibly go in a case of a problem to an arbitration situation. But then you have to, and I really don't know that from my mind, whether Germany and Brazil have checked that box and have considered each other as a contracting party, and whether they also both agreed on arbitration. And that I can help you if you ever have a question about it, by the way, but that's something you have to find out, because suppose everything goes wrong, and suppose that based on abusive rules you cannot go on the map, arbitration could help, although also for arbitration it goes if it's abusive. But then OECD has said that the countries should not use the abusive argument and should grant access to the arbitration procedure. I know that a lot of states do not follow up on this, but that's officially the perspective. So it's complex. Taxpayer rights is really an issue.
Yes, exactly. Thank you very much for your comments. I really appreciate it.
Anyone else would like to make a question, a comment? Okay, so, well, that was the last case for today. We are also with our time ran out, so, but we are available to continue discussing these matters and others that you might have. We'll also have our session next month, which we'll still define the exact date and let you all know. I would also would like to ask you to give us feedback on how this session went, things that you liked, maybe what kind of topics you would like to be discussed, and how we can get you to interact more with us. That would definitely be great. But that's it for now. I once again would like to thank Professor Hans, Hilmar, and everyone from HHP on behalf of our team in Hydro Fagundes. And
Yeah, and of course, thank you too for organizing this, Flavio, with your team. Thank you very much.
it's our pleasure. And thanks for all the participants for your attention. Okay.
Have a nice day, everybody. Enjoy your day.
Yes. Goodbye.
Bye-bye.
Bye.